Before any discussion of strategy, before active versus passive, before stock picking versus indexing, there's a mathematical reality that shapes every outcome before a single investment decision is made. Cost. Not as an abstract concept, as a compounding drag that operates continuously against every dollar in the portfolio. A 1% annual fee sounds inconsequential. 1%, a small number, an amount that feels like a reasonable cost for professional management. But fees don't operate on a single year's return. They operate on the compounding base, and the drag they create isn't additive, it's multiplicative. Consider two portfolios, both starting at the same amount, both generating the same gross return. One with a 1% annual fee, one with a cost of nearly zero. After 20 years, the difference in ending value is not 1% per year compounded. It's the entire compounding differential of a portfolio that kept one more percentage point working for 20 years versus one that gave that percentage point to a manager every year. The fee doesn't just reduce returns. It removes capital from the compounding base, capital that would have generated returns on returns on returns for the entire remaining holding period. The fee drag problem is compounded by tax inefficiency. Active management involves trading, buying and selling positions as the manager's view on value changes. Every sale of a profitable position generates a taxable event. Short-term gains taxed as ordinary income, long-term gains taxed at capital gains rates. In a taxable account, the active fund that trades regularly is generating tax obligations on behalf of the investor every year the fund is held. Not just on distributions, on the trading activity inside the fund, trading the investor didn't initiate and may not have chosen. An index fund, held for years, generates minimal trading, minimal turnover, minimal taxable events beyond the investor's own decisions. The tax drag of active management adds to the fee drag, compounding the headwind that the active strategy has to overcome just to break even with the passive alternative. The headwind number matters. If the market generates 8% annually and an active fund charges 1.5% and generates another 0.5% in tax drag, the active fund needs to generate 10% gross returns just to deliver what the index provides net, consistently, year over year. In a market where consistently generating 2% alpha, 2% above what a passive strategy captures, is something the evidence shows almost no manager does sustainably. The fee and tax headwind isn't a small disadvantage to overcome. It's a structural barrier that most active strategies never clear. This is not a commentary on fund manager intelligence, or effort, or analytical capability. It's a mathematical observation about the relationship between costs and compound returns over time. The investor who pays more needs more gross return to end up in the same place. And in a market where information is widely disseminated and prices rapidly reflect what's known, generating that additional gross return consistently is structurally harder than it appears from the outside. Before strategy, before manager selection, before any analysis of active versus passive, the cost structure has already shaped the probable outcome. And in most cases, it has shaped it against the active investor. Active management underperforms not because fund managers are unintelligent. The people running actively managed funds are among the most analytically capable in the investment industry. Deep research, sophisticated models, access to information retail investors can't access. And yet, the data on active management performance over long time horizons is remarkably consistent. Most actively managed funds underperform their benchmark index over periods of 10 years or longer. Not most bad funds, most funds, including the ones run by capable people with significant resources. The underperformance isn't about capability, it's structural. The first structural cause is the efficiency of the market itself. In markets where information is widely available, where thousands of analysts and fund managers are examining the same securities, building similar models, arriving at similar conclusions, the price of a security rapidly reflects the aggregate of all that analysis. Which means that finding a security that is meaningfully mispriced, that represents genuine value not yet reflected in the price, requires being right when thousands of other analysts are wrong. Not occasionally, consistently, year after year, with enough frequency to overcome the cost headwind and still deliver excess returns. In highly efficient markets, that's what alpha generation requires, and it's much harder than most investors manage their expectation of the difficulty. The second structural cause is the benchmark problem. Actively managed funds are measured against a benchmark, usually a market index, and that measurement creates a specific behavioral dynamic. A manager who holds positions very different from the index, who takes the concentrated, differentiated positions that would be required to generate meaningful alpha, is exposed to significant tracking error. If those positions underperform, even temporarily, the manager faces redemptions. Investor capital leaves the fund. The manager's career is at risk. So the rational response for most fund managers is to hold a portfolio that looks similar enough to the benchmark to limit career risk, while still charging fees for active management, which produces a portfolio that's unlikely to dramatically underperform, but equally unlikely to dramatically outperform after fees. The incentive structure of active management pushes toward closet indexing, paying active fees for near-passive exposure. The third structural cause is mean reversion in performance. A fund that outperforms in one period is not statistically likely to outperform in the next. The evidence on performance persistence, on whether last decade's top-performing funds are this decade's top performers, is weak. Outperformance is more often explained by factor exposures, by tilts towards certain types of securities that happened to perform well in a given period, than by persistent manager skill. When those factor exposures revert, when the market environment changes, the prior outperformance reverses, and investors who chased the prior performance have arrived at the party after the best returns have already been captured. None of this means active management never outperforms. Some managers do, in some periods, in some asset classes where information is genuinely less efficient. But the question for any investor considering active management isn't whether it's possible to outperform. It's whether the specific manager they're choosing will do so, net of fees and taxes, over the specific time horizon they're investing for. And the evidence on that question, consistently, across time horizons and geographies, says most won't. Not because they can't analyze, because the structural properties of markets, costs, and manager incentives are working against them before the first trade is placed. Pause for a second. If you're still listening, it's probably because this didn't feel exaggerated. That's intentional. If this way of thinking matters to you, like the video, subscribe. We'll keep going deeper. Index investing is consistently misunderstood as settling for average. The logic seems straightforward. An index fund owns everything. It captures market returns. It doesn't try to beat anyone. And in a world where winning feels like finding the right stock, timing the right entry, selecting the right manager, not trying feels like not competing, like accepting second place, like giving up before the race starts. That framing is wrong, and understanding why changes how index investing is actually evaluated. An index fund doesn't capture average returns. It captures market returns minus a very small cost. The distinction matters because of what's on the other side. Active strategies don't capture market returns plus the value of active management. They capture market returns minus fees, minus trading costs, minus tax drag, minus the performance cost of the positions that underperformed while the manager searched for the ones that didn't. In aggregate, across all active investors, the market return is what exists. It's the return available before any costs are applied. Active investors, in aggregate, earn the market return, then pay fees, then pay taxes, then end up below the market return. Index investors, in aggregate, earn the market return, then pay a very small fee, then end up just below the market return, but above the average active investor. This isn't a strategy preference, it's arithmetic. What passive investing actually provides is a structural elimination of friction, not skill, not research, not prediction. The removal of the costs that cause most active strategies to underperform the market they're trying to beat. Low turnover means minimal trading costs, minimal taxable events in taxable accounts, low fees that don't compound against the investor's returns year after year. The index fund doesn't win by being smarter than the market. It wins by not losing to its own costs, which, given the structure of how markets work and how costs compound over time, is an enormous structural advantage. There's a second property of index investing that gets underappreciated: behavioral consistency. Active investing creates conditions that are hostile to good investor behavior. Performance that varies dramatically from the market creates emotional pressure. When the fund lags the market, which happens regularly even for good managers, the investor faces the question of whether to hold or sell, whether the underperformance is temporary, a period to hold through, or permanent, a signal to exit. That question, repeated across down periods, produces a specific behavioral pattern: selling after underperformance, buying after outperformance, the exact opposite of what produces good outcomes. Index investors face a simpler version of that question. The fund tracks the market. Periods of underperformance are the market underperforming. The question is whether to believe in long-term market returns, not whether this specific manager is still worth holding. That simplicity doesn't eliminate behavioral error, but it reduces the frequency of the conditions that produce it. Index investing is not a philosophy of mediocrity. It's a structural approach that correctly identifies where the friction in the investment process lives: in costs, in taxes, in behavioral error, and eliminates as much of it as possible. The investor who understands this isn't settling. They're removing the structural obstacles between their capital and the returns the market actually generates. And that removal, applied consistently over a long enough time horizon, compounds into something that most active approaches never match. The persistent outperformance of passive over active investing over long time horizons isn't an anomaly that will eventually correct. It's a signal. A signal about the structure of markets, about what information is already priced in, about what it actually costs to try to extract returns above the market, about the nature of the competition retail and even institutional investors are facing when they attempt to do so. The first thing the data signals is that markets are more efficient than most investors believe. Efficiency in this context has a specific meaning. Not that prices are always right, not that mispricings never exist, but that known information is rapidly reflected in prices, rapidly enough that finding it first or analyzing it more accurately is harder than the cost of trying makes it worth. The market isn't perfectly efficient, but it's efficient enough that the edge required to overcome the cost of active management is not reliably achievable by most participants. And the data on active manager performance over long periods, across markets, across fund categories, across geographies, confirms that conclusion with remarkable consistency. The second thing the data signals is about the nature of the competition. Active investing is a zero-sum game before costs. For every dollar that outperforms the market, there's a dollar that underperforms, by definition, in aggregate. And the participants competing for the outperforming dollars are not equally distributed. Institutional investors with full research teams, alternative data access, algorithmic execution, and decades of pattern recognition are competing against retail investors with a brokerage account and a financial media diet. In that competition, for the same zero-sum pool of outperformance, the outcome over time is predictable. The retail investor who attempts to pick stocks, to time markets, to select the right active manager is generating the underperformance that funds the institutional outperformance. The third signal is about what complexity costs in the investment context. Most investors assume that more complexity produces better results, more analysis, more trading, more sophisticated strategy, more active management. The evidence consistently shows the opposite. Complexity in investing primarily adds costs in fees, in taxes, in trading friction, in behavioral errors generated by the emotional complexity of active decision-making. Simplicity, owning a broad, low-cost index, eliminates most of those costs without sacrificing the underlying market return. The counterintuitive conclusion that the evidence supports is that in investing, unlike most domains of performance, doing less usually produces better results than doing more. What the persistent outperformance of passive ultimately says about the market is this: the market is not a place where most participants can reliably extract returns above what the market itself provides, after accounting for the cost of trying. It's a mechanism that efficiently allocates capital and generates returns for participants who are positioned to receive those returns with minimal friction. The investor who understands this, who positions themselves to receive the market's return rather than to extract alpha from it, is working with the structure of markets rather than against it. And over a long enough time horizon, with low costs, with consistent behavior, with the compounding running uninterrupted, that alignment with the structure produces outcomes that most active approaches never reach. If this shifted something for you, subscribe. Like this if it clarified something.